Boom! Welcome, guys. Happy Friday. Welcome to the Bold Effect podcast, guys. My name is Mamadou Diallo, full-time real estate investor, guys. And this episode is all about bringing you bold entrepreneurs, but also bold attorneys like the one that I have here today with me, who is not only my private attorney, but also the closing attorney that I use in the DMV to close all my creative finance deals. And guys, you guys already know the number one question we get all the time about when it comes to creative finance deals, but most specifically subject to deals, is the due on sale. I call it the boogeyman that most people have never seen, but they just talk about it, especially gurus that have stopped doing deals in the 1980s. And so I'm bringing to Michael today, has a lot of experience. I'm going to let him introduce himself, and then we're going to dive into this topic of the due on sale clause when it comes to subject to deals. So, Michael, introduce yourself. Let people know who you are, what you do before we get into it.
Well, my name is Michael Gross. I'm a real estate attorney here in the Washington, D.C. area. I'm admitted to practice in D.C. and Maryland. And my practice revolves around advising investors on all aspects of purchasing and investing, holding, managing real estate. Everything from writing a contract to getting you all the way through settlement, because I'm associated with ATG Title. We do real estate settlements in the entire DMV area and other parts as well. As you can tell, I've been doing this for a while, somewhat over 40 years. In that period of time, I've done quite a bit with alternative financing, including or subject twos, and have run across people concerned about the due on sale clause very often.
Right. Awesome. So you guys can tell from his sexy black hair that, yes, he's been doing this for a while. Don't let the hair fool you. Michael is super young, super sharp, really knows his stuff, and I love working with him. So, Michael, let's get into it. Like I was saying, the due on sale, first and foremost, let's go back, because the first question would be, a lot of people think when it comes to subject to deals, this is a new concept. As far as you can remember, how long has this been done in the real estate space?
Well, taking title subject to is probably older than the United States, because we picked up our legal theories and concepts from England. When the colonists came over here, they didn't start everything fresh. And people were doing this sort of thing effectively for close to 1,000 years. It arises out of really some medieval English law, but it's been in American law, it's been in Maryland law, DC law, since the beginning. As a matter of fact, until the 1970s, a rather substantial portion of all real estate changed hands through something like assumptions or subject to deals. It's only recently meaning the late 1970s, when the banking laws began to change, that due on sale became less, that subject tos became less common. But every time there's a hiccup in the interest rate market, they come right back out again.
Like right now, guys, we're in that perfect timing where there's a hiccup in the market, interest rate is super high, a lot of properties not selling. And just yesterday, we have a property here in Atlanta that we locked up at 2 point some change percent interest rate. So you guys, and we're locking it up subject to, so you guys can see the value when it comes to subject twos, especially with this type of market right now, where like the average interest rate, I think right now is 7%. And so the first myth that we just got, threw out of the window, guys, is that it's a new concept. It's absolutely not a new concept. It's been done for years and years. And the due on sale, we're going to dive into it. So first, you just said something, Michael, and I want to make the distinction between these, because I've noticed both new investors and real estate agents confuse these two terms. When you bring up subject to, they confuse it with loan assumptions, right? And I just heard you mention about loan assumptions. What is the difference? What is the core difference between subject to and a loan assumption?
Well, the difference is how many people are involved. In a true assumption, there are three people involved: the buyer, the seller, and the bank. And effectively, the buyer and the seller go to the bank and they say, we'd like you to take the seller off of liability for the mortgage, release them, effectively erase their name off all the loan documents, and put my name, the buyer's name, on in their place, so that the buyer becomes directly responsible to pay the bank. It becomes his or her credit that's on the line. That's distinguished from subject to transactions, which are two-party transactions only between the buyer and the seller. The seller says to the buyer, I don't want to pay my mortgage anymore. You take over the job of making my payments. And the buyer tells the seller, fine, I will make your payments, and effectively I will become responsible for the loan as between the two of us, and cover all the costs and hold you harmless from it. But again, that's only between the two of them, and the bank is not involved, so the bank doesn't know anything about it, basically.
Right. So that is a clear distinction. So that means so what we're talking about specifically, guys, today is not loan assumptions. So we don't do loan assumptions. You can do it, but to me, that's, you can only do so much, because what you're really doing is, now that loan is coming on your credit, your name, so you're kind of like, you can only do it maybe 10 to 12 properties. After that, the bank is probably no longer going to give you loans, because you can only max out your credit, your wife's credit, your girlfriend, your cousin's credit so much, right? So what subject to deals allow you to do is buy more properties at a faster pace. The bank is not involved, it's way faster. You negotiate the terms directly with the seller. And the ideal sellers usually that do this, for people that always ask the question of why would the seller do this, is typically is because they're highly motivated by the mortgage is a huge pain. They're behind under mortgage, going through divorce. The pattern that, at least that I noticed, medical bills. There's something there that's motivating these people, and this mortgage is a huge pain for them. They can no longer afford it. And they just, as long as they trust you, you're a credible company, you can make the payments, they wouldn't mind you taking it over, they leave it in their name, and you keep making the payments. So let's go into the do on sell clause, Michael. So all these years you've been doing closings with subject to deals specifically. How many times would you say, by the way, Michael, do you have any statistics on how many like subject to deals is done, maybe not daily, maybe monthly, just with you guys, ATG Title? Like how many transactions people close on average?
I really don't have statistics about it, other than to say that whenever there is a change in the mortgage market and interest rates get higher, the subject to transactions come out, because they wind up being cheaper for all parties. The buyer gets to take over a lower interest rate. They get to settle more quickly because they don't have to go through the loan application process with the bank. So it's quicker for them, and they don't have the costs involved in setting up the loan. Within the investor community, of course, subject to deals have never gone out of favor. I was doing them when interest rates were 1% and 2%. They're still there because they're so flexible, particularly if a seller is motivated and wants to move quickly. And you've got a property where if you throw, we'll say, real estate agent commissions and everything on top of the price, it's going to be uneconomical. So investors will very often do a quick subject to that way, and everybody comes out ahead.
Yep. This is why I argue that doing subject twos, guys, is sort of a recession proof, because you can do it in any market. Whether the market is good or the market is bad, stagnant, really doesn't matter. But so the do on sell, Michael, first of all, let's define what the do on sell is. Let's say somebody that have no clue what the do on sell is. In maybe 2 sentences, what is the do on sell?
2 sentences is a little short, but I'll do it. ever since the middle 70s, as I said, most mortgage loans have contained a provision which says if you sell the property, you agree to pay us off. It's just in the contract between the buyer and the bank. It's commonly referred to as the due on sale clause in the mortgage. And that is just a contractual agreement between the two parties. So then if you go and sell the house without paying the bank off, then you've violated that agreement you made with the bank back when you originated the loan.
Yeah. Okay. So the bank has the right. It doesn't mean they're going to do it. So with that being said, have you seen with all the transactions you've done where the bank actually called the note due and also enforce it, literally force the investor? Because when you're doing a subject to, if you're new guys, subject to is you leave the loan in place on the seller's name. You do not, because this is another thing maybe, Michael, we can talk about later. Like mechanically, people wonder, how can you transfer deed and title and leave the mortgage in place? This is something that baffles people in their head for some reason. I know it did for me when I first got started. But maybe we can dive into how, what the note, the deed, the title and deed and the mortgage, what separates them. That's number one. But number two, have you seen it actually called by a bank and then enforce, throughout the whole transactions you've done so far?
Of all the transactions I've done, going back since the beginning of my practice, I've only come across one bank, one situation where the lender said, ownership has changed, therefore we are calling the loan due. This was actually a rather special situation. It was a state of Maryland government loan years ago that could only be held by a low-income owner-occupant. And the lender basically, the servicer basically said, we don't want to foreclose on you, but we have to foreclose on you. The investor talked to them for a while, and they arranged to misplace the file for 60 days. And lo and behold, in those 60 days, the investor refinanced, the bank was paid off. That was the end of the story. But otherwise, as long as the loan doesn't go into default for non-payment or some other reason, the lenders really have no interest in enforcing the due on sale clause just because ownership changed. Frankly, the banks are in it for the money. As long as they're getting paid, the idea, no point in kicking a sleeping dog. Let them lie and just enjoy it. This is for a couple reasons, but mostly because a lot of the loans out there are held by these, large investment trusts and what have you, not really by any particular bank. The bank is very often only doing the collecting. So if the collecting bank is getting paid by volume of what they collect, they have no interest in not collecting, i.e. declaring a default. And the underlying investment trust or whatever, all they want is their money. They don't particularly care who owns the property. So as long as the loan is being paid on time, there's the incentive for anybody to declare a default is relatively nil.
Yeah. And something that you guys, if you're new, what you have to remember is that they're not in the real estate business, they're in the lending business. And so typically, and correct me if I'm wrong, Michael, for us, what we typically tell our audience or newbies is, hey, stay away from doing subject twos when it comes to small community banks. You can do things like agreement for sale, where it's sort of a subject to, but you don't transfer the ownership. You leave it in place. Because small community banks, every time we've had that issue was mostly with them. And then we've had one scenario similar to the one you just spoke about, where we're doing a deal and the seller, like you said, went through a down payment program with the county or whatever. And there was no way for us to transfer deed and title without triggering the due on sale because of that specifically. So what we did is we still did the subject to transaction, but we did it as an agreement for sale where she was keeping deed and title in her name, and we're just, we keep making the payments. We have equitable interest, I guess you would call that, on the property until we pay it off or refinance or whatever. But typically, we tell people stay away from doing that with small community banks. Keep deed and title on the seller's name and just keep making those payments. So you can still, maybe Michael will have better terms to explain what type of transaction he would call that. Because I've noticed every state almost, Michael, call that differently. When you do sort of a subject to transaction, but you don't transfer deed and title, maybe you can let me know what are the different names that are out there. That's number one. Number two is I found where, because some of these deals we actually wholesale them. I think I've done a few with you, Michael, where I've actually wholesaled to another investor because I didn't want to keep it myself. And one of those investors ended up messing up the insurance in the back end. So what he did is he went and canceled the insurance on the seller's name, because obviously if you leave the loan in place, most loans have all of that escrowed in the mortgage. So do you also have an advice on how people should handle that part when it comes to the insurance in the back end once you close escrow? Because I think also on top of paying the mortgage on time, obviously.
Well, insurance is an issue for people, but it really shouldn't be. I agree that it's not a good idea to cancel the existing insurance policy, because what will happen is that the escrow department, the insurance department at the bank, is going to notice that the insurance has been canceled. And since it's an important condition of the loan that the property stay insured, after all, the lender doesn't want to foreclose on a smoking pile of ashes after the place burns down. That will trigger people to look at what's going on. They'll probably more likely foreclose if the insurance is canceled because the insurance is canceled, but one way or the other, it causes a problem. People sometimes will have the buyer added as an additional insured on the mortgage, or sometimes they'll simply carry a parallel insurance policy. As an investor, I would suggest that you have a relationship with an insurance carrier. And if you're going to buy subject to, buy a property subject to the mortgage, go to your insurance agent and say, this is what I've done. What kind of coverage should I have? And they may tell you to carry a parallel policy just in order to make sure that you're covered appropriately.
Okay.
You'd also, there was a first question you had there, and I've missed it because I was answering.
Yeah.
I think it's generally true that the smaller the lender, the more likely they are to keep tabs on their mortgage and the details of the mortgage, because they're not operating in big multi-million-dollar numbers. They're not operating on average, you might say. Each loan to them is important. So that may require more care when you've got either a private lender or a small institution. And I agree with you, they're the ones who are more likely to notice if ownership changes. You'd also, there was another item you mentioned, I'm trying to remember.
Yeah, when you buy the property subject to, but you don't transfer deed and title.
Yeah. Because we've got a federal system with 50 different states and 50 different sets of laws, you're going to find it slightly varying from state to state. Some places will have you execute, they'll call it a land installment contract, where you enter into a contract that gets recorded in the land records, and you're buying the property over time from the seller. You pay them, they pay the bank. Some places call that contract for deed. And then there are any other number of ways of doing creative financing that will let you accomplish the same thing, getting control of the property, getting the cash flow for the property, and ultimately settling on it and becoming the owner later. There are many different ways of structuring that.
Yeah. So we have a question in the audience. What's a parallel policy? I think it's just a
You have your own insurance policy on the property separate from the one covering the bank. If you think about it, let's assume you've bought the property from the average homeowner. Well, they got an owner occupied homeowner insurance policy. Um, if they now move out and give you the property and you're operating it as a rental, and you have a loss of some kind, the original insurance company, if they're not told that they're now covering a rental property, not an owner occupied property, could say, wait a minute, we didn't agree to cover a rental property. The risks there are different. You weren't honest with us about what you're doing with the property, and we're going to deny coverage. I mean, an insurance company's first answer always is to say no, obviously.
right.
So either you might want to go take that policy and tell the bank, tell the insurance company, oh, it's now a rental policy. We, the original purchaser, are no longer living in the property, and get that done. And you can go and maintain, as I said, a sort of a parallel insurance policy that will insure you, the buyer, as well. And if there's a loss, obviously the insurance companies will figure out between the two of them who pays. But it's worth talking to an insurance agent about, because I'm not a property and casualty agent, so I'm not advising there.
That's what I was gonna say. So it's the same thing, guys. When you do real estate transactions, there's multiple people you need on your team. When I say on your team, it doesn't mean literally, but it's you gotta build relationships. One is an attorney. You always want an attorney on your team, on a retainer, to advise you legally, because like real estate is every single transaction can be different. Certain transactions can be super complicated. Your paperwork is so make sure you have an attorney. Insurance agents, guys, these people they want your business, just FYI. Like for us, I had to call like 5, 6, or 7 people to find an agent that knows what they're doing. Like they understood subject to, they knew exactly what I was doing, and they were excited about it, and they were excited that I cold called them to build a relationship, because I'm gonna bring them business. So just cold call insurance agents and talk to them and tell them exactly what you do, and see you're gonna have to vet them, you're gonna have to interview them because you're paying them, right? So you gotta have these things, title companies. Every state that you do deals, if you're doing especially creative finance deals, a lot of title companies out here don't know what they're doing when it comes to that. So you want to make sure you call title companies and you vet them and make sure they understand and actually have done these type of transactions. So it's the same thing with the insurance policy. So with that being said, Michael, so let's say hypothetically, right, you close on the property. Let's say Wells Fargo, let's say the lender is Wells Fargo, and they decide, you know what, we just found out that you bought this property, you transferred deed and title, and you didn't pay off the loan, so we're gonna call the note due, even though you are on. This is just a hypothetical scenario. Even though you're paying on time, we still want you to pay it off. What is some of the solutions that the investor have in order to and I'll tell you what we typically do if that ever happens, like the solutions that we have on the table at least. We've never once used it yet, because I've only had once, which I think I told you the story, Michael. Wells Fargo called me about a deal that I closed with you on Eileen Road in Maryland, and they wanted to. I mean, the ex-wife wanted to blackmail me for $5,000. She went to the bank and told them, "Hey, my husband passed away. Mamadou bought my property subject to," and blah 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 blah. Literally, they just called me and said, "Hey, send us your closing documents." They verified payments was on time. Called me back and say, "Hey, just keep making the payments." That's the only thing I get from them. So far, they haven't foreclosed, at least yet, right? And we own dozens and dozens of properties subject to. We don't have that issue. But let's say it happens. Is there maybe insurance companies out here that can cover you at closing? So maybe they fight the bank for you or refinance you out? Or is there a way maybe where you deed it back to the seller if they haven't been abducted by aliens yet? Then you buy it on the land. Like, is there any solutions? Let's say hypothetically it happens.
Well, there's always the solution of refinancing the property.
That's one.
The lender probably wants just to get paid. Ultimately, the lenders don't want to own the real estate. That's the last thing they want, because then it's nothing to drag and a drain of their assets. And so they'll probably cut a deal with you if you say, all right, I'll tell you what, I'll go out and refinance property and pay you off. Give me 60 days, 90 days, whatever it is. They will probably work with you. The other thing about it, by the way, just if we're thinking about subject to financing, is that you have to remember that when you're taking a property subject to the seller's mortgage and paying the mortgage, you are keeping up the seller's credit rating. You're doing nothing for your own credit history. Mm-hmm. So at some point or another, if you're going to be holding the property long term, you probably want to refinance it anyway, so that you start building your own empire, you might say, not the seller's. But that having been said, as Mamadou, as you pointed out, most often the banks just want to get paid. Offering a refinance is probably the most effective thing to do. Theoretically, under the deed of trust, you're not supposed to be able to deed it back to the seller. And besides, remember, you've got transfer taxes going both ways, so that ultimately winds up costing money. I've never had the opportunity to think it out in full, because frankly, it's never happened.
That's the thing. That's my point. That's where I was going with this, because this is why I call it the boogeyman that everybody's afraid of and nobody's ever seen. Every single time I've had, a guru say, stay away from these subject to deals, you're gonna go to jail, blah, 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 is I noticed they've actually never done it. So guys, the problem to answer even these questions sometimes is that it doesn't happen, especially if you stick to doing them with big banks. But the worst case scenario, if it happens, I only know one friend that it happened to him, I think twice. And like I said, again, it was all small community banks, not big banks. But even then, the bank themselves told him exactly the solution. One of them, that small community bank, told him, hey, just the solution that I just said, Michael, they told him, deed the house back to the seller and buy it on an agreement for sale or a contract for deed, call it whatever you want, which he did. I know there is transfer tax and all of that, but it's better than getting foreclosed on. So he did it, and he rebought it. I think it was either for $1 or for the underlying loan. I forgot exactly, but that's the solution that the bank themselves told him to do. They said, listen, we don't want to foreclose on you, but we have to, like you just said earlier. But it was a small community bank. That's how I learned from him to stay away from small community banks, because they're on track. Number two, let's say hypothetically a big bank decides to foreclose on you. Just so you guys know, it doesn't take them 2 days. So you typically have between 60 days or 90 days. So you can go out to a lender and refinance within that time frame. So it's not like if you receive a letter today saying, hey, pay us off, tomorrow Wells Fargo is coming and grabbing your house. And that's not how it works. There's a whole process. I think, Michael, right? They got to go through the foreclosure process and all that fun stuff. So you have time to refinance the property. There was one insurance company, Michael, that we've dealt with in our network. They were saying that if you reach out to them prior to closing on subject to transactions and you pay them, I think it was a 1% of the purchase price or something like that, they would insure the transaction. And in case the due on sale is called on you, they will not only fight the bank for you, but let's say hypothetically the bank push for the foreclosure, they will pay off the bank and you keep paying them. But we found out that they were advertising things they actually don't do, because so it was a weird thing. But the main thing is here, guys, stop being afraid of the boogeyman that doesn't exist. As long as you do the transaction the right way, use the right title company, use the right purchase and sale agreements, not the ones that you download online for free. Do not do that. Don't be cheap. Don't be cheap. Go pay an attorney. It doesn't cost as much as you think, okay? And then fourth, when you close on it, pay the mortgage on time. Pay the mortgage on time. That's the number one trigger for the due on sale, is when you're always late. Obviously, then the banks start looking into it, because they're looking at why is this person always late? Now they want to foreclose. And then here's the big question, Michael. The big question is always, attorneys and realtors, their number one thing they say about subject twos is that it's illegal, is a fraud, is this. Like, what would you say to that?
Well, it's not illegal. The police are not going to come and take you away because you did a due on sale transaction. It's a breach of contract. The seller had a deal with the bank, a contract with the bank. I will pay you off if I sell. And so they breached that contract. If a contract is breached, it gives the other side the right to do something about it if they feel like it, but they don't have to. I mean, people breach contracts all the time. Imagine that you hired somebody to cut your grass and trim your bushes, and he said, fine, for $100, I'll be there on Tuesday and I'll get the job done. Monday night, he calls you up and says, gee, I don't know, I've just got coronavirus. I feel terrible. I won't be able to be there Tuesday, but my brother Charlie, who's also got a landscape business, said he can do the job for you for $100 on Wednesday. All right, the first guy's breached the contract. You could say, sorry, that wasn't our deal. I need it done now. I'm having a garden party or something. I need it done now. Forget it. Or you could say, fine, Wednesday works. And you just go along with the breach because it's just as good for you.
Right.
Well, if the bank just continues accepting the money under due on sale subject to transaction, instead of bringing the due on sale clause into effect, they've just decided that your alternative performance is just as good for them as the original performance. They're still getting their money at their interest rate.
Right.
As long as you keep making the payments, they'll probably be happy.
Right.
Theoretically, they could decide at any point, we've had enough of this, we want to foreclose on you because ownership changed. It's just not terribly likely in my experience. But you, in the back of your mind, need to be ready for that so that if it happens, and you're right, Mamadou, if the bank says we're going to foreclose on you, there is a decent period of time between the time they do that and the time the judge bangs the gavel or whatever and says you've lost your property for you to take action. But as long as you recognize that it's a theoretical possibility and you're able, we'll say, to refinance or to turn around and sell it quickly to someone else and have them pay the bank off, then you'll be okay.
All right, that answered that question, guys. So stop being afraid of it. I always say if you're afraid of three things, do not even start in real estate or entrepreneurship in general. If you're afraid of lawsuits, because it's going to happen, especially if you're successful, it's absolutely going to happen. Tenant headaches, toilet leaks, projects going wrong. Like, listen, just keep your job, keep your 9 to 5, and don't even look into it. Okay, it's not for you. So with that being said, Michael, there's another question that I got recently, which was, I thought it was a great question. Let's say you take over a property subject to, like the one we did on in Glen Burnie, okay? The guy passed away, the seller passed away after he sold me the property, that 1 month or 2 months later. And his family now, oftentimes when people pass away, there's a probate process, right? So if I bought it subject to, I own the property now. The only thing left on the seller's name is the mortgage. Somebody was telling me, well, what happens if the family come back and they want to add the property to the probate? My answer was they can't because you own it. They don't own it any longer. But what is your answer to that? What is that? Is that something that can come and bite somebody when the seller, let's say hypothetically, the seller get abducted by aliens later, but you bought the property subject to, and the family is going through the probate process?
If your seller was competent, mentally competent to make a contract back when he sold you the property, it's your property, and his heirs have nothing to say about it. If there was no limitation in the deed or whatever that said the heirs own some sort of ownership interest in the property, the seller's free to do whatever he wants with it. The loan is not in the heir's name, it's in the name of the deceased owner. So they have no personal liability for the debt. It shouldn't affect them at all. Now, if, Uncle Harry had always promised the house to nephew Charlie, and Charlie's upset that Uncle Harry sold it, well, that's his problem. But if Harry was, mentally competent and able to make a contract, Charlie is stuck with the fact that he's not getting the house.
All right. Boom. So there you have it, guys. So they cannot include in the probate process, which I answered that question already also. So guys, leave a comment below if you have any other additional questions. We can talk about this topic all day long. But the takeaways here is, number one, is not illegal. It's just a breach of contract, which hypothetically, we just talked about how to handle it. Number two, right way, wrong way to do it. Number three, stay away from small community bank when it comes to subject twos. Do it with the big banks. With small community banks, do land contracts for deed. Every state call it differently, but it's just you buy it subject to, but you're not transferring deed and title. That's all it means. Another myth, maybe this is probably the last questions on this topic, Michael, is there is some people online that says if you want to avoid the do on sale, close on the property using is it a land trust? I think a land trust. Is that a myth or is that a thing?
Well, now I'm speaking from a Maryland point of view.
Okay.
The idea of a land trust is more or less a Western concept. It is not quite so much here in the East. There are things in the West that are specifically set up as trusts for the purpose of owning real estate. You can create a trust and put the name in the trustee of a trust. And I have seen people now in Maryland, if the seller places property into a trust that they own, like an estate planning trust, there is no transfer tax. People sometimes confuse the two issues, putting the property in trust to avoid, they think to avoid transfer taxes. But most due on sale clauses read that if an interest in the property is transferred, and it doesn't use the word actually sale, and that's a much broader arrangement. How you take title to the property is sort of secondary to the concept of the bank's ability to take the property away if interests in the property are transferred, if ownership transfers. The other thing about it, people sometimes, if you don't mind my getting off on a slight tangent, people think if I put the property in a trust, nobody will know it's mine.
Oh, yes.
It doesn't work that way. If you think about it, if you're out there showing the property, managing the property, talking to people about it, your name's on the business card when you're dealing with people, it doesn't take a rocket scientist to realize that you have a relationship with that property or with that entity.
But do attorneys really go to that length to find somebody in case of a lawsuit?
Nobody's that far underground anymore. Not with the internet. You're just.
Yeah. But you're right. I hear about it a lot when it comes to anonymity. People say if you want to have anonymity, use land trust and all that. Not versed in it. And then again, guys, seek counsel on your own state, because most states also have different rules and regulations. And if you don't have an attorney, if you want to invest in real estate and you don't have an attorney on a retainer, I'm sorry. Number one, you're doing it wrong. Number two, you're too cheap. Number three, you're probably not a real investor. You're not looking to grow and build a whole legislative portfolio, because you're going to run into issues where you're going to need legal specific counsel based on the specific situation. Because I've noticed, especially in the creative finance realm, Michael, is every transaction is so different depending on the type of loans involved. Sometimes we buy properties where you have 4 different type of loans, from the lender to HELOCs to how do you call it, solar panel liens. So like seek counsel and then make sure your title company understand what you're doing. Build a relationship with insurance agents And listen, if you bring in business to a title company, typically the closing attorney doesn't mind responding to your questions if you have that question, but I would definitely have an attorney on the retainer. So guys, leave a comment below. Let Michael know how much you appreciate him for coming up, giving his time, answering these questions. That's number one. Number two, if you're in the DMV, if you're doing real estate transactions in the DMV, both cash and creative, ATG title, that's who I use. Michael is the closing attorney there. Make sure you use them, reach out to them. I'll put also their link in the description below. Let Michael know how handsome he is with that gray hair. It's not even gray. And I'll bring him next time. We're talking about, which we already have the topic, Michael, different contracts. I think you told me. We'll talk about that. Will be a fun one, guys, because there's so many like it's just fun. And Michael is super passionate about this kind of topic. So and some of the actual events, physical events we do in the DMV area, Michael will often come and be one of the guest speakers. So guys, connect with him. Use ATG title when you're doing real estate. By the way, they're in different other states. We're using them in Florida right now. So if you're in Florida, also check them out. We're using them also right now. They're amazing. And Michael, thank you so much for coming. Any last advice for investors when it comes to subject to deals?
My pleasure. Happy to talk to you anytime.
Absolutely. Thank you so much for coming up, Michael. Guys, make sure you like, subscribe, hit that notification bell, okay, so you don't miss out the next time that I go live. I'm going to bring back Michael. You guys let me know in the comments maybe if there is another topic that you guys want to hear from Michael specifically. And like, subscribe, hit the notification bell. Every single Thursday, check me out on the Bold Effect podcast. Connect with me on Instagram, TikTok, Snapchat, all, the major social media platforms. And until next time, I'll see you in the next video. Stay bold, be bold. Most importantly, go out, take action, and do deals. Okay? Do deals, squad up, partner up with people that know what they're doing if you're new and you don't know what you're doing. Until next time, guys, peace.